Ever felt like you're playing a high-stakes game of tug-of-war with your finances? On one side, you need a loan for that dream home renovation or to finally tackle that mountain of debt. On the other side, a confusing mess of terms, rates, and repayment plans. Today, we're demystifying one of the biggest pieces of that puzzle, the personal loan term. Stick around, because by the end of this video, you'll know exactly how to pick the perfect term length that won't just get you the cash you need, but will also save you a ton of money. So, what exactly is a personal loan term? It's super simple. It's the amount of time you have to pay back the money you borrow. Think of it as the finish line of your loan marathon. These terms can vary a lot, typically from 1 year all the way up to 7 years. Some lenders might offer shorter ranges, like 3 to 5 years, while others might go even longer, maybe 10 years or more, especially for those bigger loan amounts. And here, as a heads up, you'll often need good or excellent credit to unlock those extra long repayment options. Personal loans are what we call installment loans. This means you pay them back in predictable, monthly chunks, usually with a fixed interest rate. So, once you lock in your loan, you'll have the same payment every single month until it's all paid off. No surprises, just a clear path to becoming debt-free. But here's where it gets interesting. The term you choose dramatically changes the entire experience. It affects your monthly payment, the total interest you'll pay, and even the interest rate you get. Let's break down how this all works. First up, your monthly payments. This is the number you'll see leave your bank account every month, so it's a big deal. A shorter loan term means higher monthly payments. A longer term means lower, more manageable monthly payments. Let's make this real. Imagine you take out a $10,000 loan with a 12% interest rate. If you choose a short 2-year term, your monthly payment would be around $470. But if you stretch that out to a 5-year term, your payment drops to just about $220. That's less than half. The longer term definitely makes your monthly budget breathe a lot easier. But wait, there's a catch. While a longer term gives you those nice, low monthly payments, it comes at a cost. And that cost is interest, a lot of it. Let's go back to our $10,000 loan example. With that 2-year term, you'd pay about $1,300 in total interest over the life of the loan. Not too bad. But with the 5-year term, you'd end up paying over $3,300 in interest. That's an extra $2,000 just for the convenience of smaller payments. So, the longer you're in debt, the more you pay overall. It's a classic trade-off. Lower monthly payments now versus higher total costs later. And keep in mind, we assumed the interest rate was the same. In reality, longer terms often come with higher interest rates, which would make that 5-year loan even more expensive. Now, let's talk about the interest rate itself, or the annual percentage rate is the price you pay to borrow money. It includes interest and any fees, expressed as a percentage. Many things affect your APR, your credit score, the loan amount, and why you're borrowing the money. But your chosen loan term plays a huge role. Generally, lenders see longer loans as riskier. Why? Because over a longer period, there's more time for things to go wrong. You could lose a job or have a financial emergency. To compensate for that extra risk, lenders often charge higher interest rates for longer terms. So, not only do you pay interest for a longer time, but you could also be paying it at a higher rate, which is a double whammy for your wallet. Another quirky thing to watch out for is borrowing minimums. Some lenders tie their longer loan terms to larger loan amounts. For instance, a lender might say you can only get a 7-year term if you borrow at least $25,000. This can be tempting. You might think, well, if I just borrow a little more, I can get that lower monthly payment I want. But be careful. Taking on more debt than you actually need is a slippery slope. That extra cash can be hard to resist spending. And suddenly, you're in deeper debt than you planned. All because you were chasing a longer term. Always borrow only what you need. So, let's recap the pros and cons of a long-term loan. The biggest pro is affordability. Lower monthly payments free up your cash flow for other expenses and goals. Plus, you might be able to borrow a larger amount, which is great for big projects. The cons: you'll pay way more in total interest. You'll likely get a higher interest rate, and you'll be in debt for much longer, which can be a financial and mental burden, potentially holding you back from other life goals, like buying a house. On the flip side, what about a short-term loan? The pros are pretty compelling. You'll save a ton of money on interest because the loan has less time to grow. You might even get a better, lower interest rate from the lender. And best of all, you'll be debt-free much faster, freeing up your income sooner for things you actually want to spend it on. The main con is that the monthly payments will be significantly higher. If they're too high, you risk missing payments, which can lead to late fees and damage to your credit score. Higher payments also mean less wiggle room in your monthly budget for savings or unexpected costs. So, when does a long-term loan make sense? Choose a long-term if your budget is tight or your income is a bit unpredictable. The lower monthly payment is a safety net. It also makes sense if you're borrowing a very large amount, like for a major home remodel, where spreading it out is the only feasible option. And here's a pro tip. If your lender doesn't charge prepayment penalties, you can take a long term for the low payment, but make extra payments whenever you can to pay it off early and save on interest. It's the best of both worlds. And when should you go for a short term? If you have a stable income and can comfortably afford the higher monthly payments without stress, go for it. A short term is also perfect for smaller loan amounts. Most importantly, choose a short term if your main goal is to save as much money as possible on interest. Paying less to the bank means more money stays in your pocket. So, how do you find that perfect balance? It's all about finding the sweet spot between an affordable monthly payment and a reasonable total cost. Ask yourself 3 questions. First, how much can I truly afford each month? Don't guess. Sit down, create a budget, and find a real number you can commit to. Second, what's my main priority? Is it saving the most money on interest, or is it having the lowest possible monthly payment to reduce stress? Your priority will guide your choice. And third, what are my other financial goals? If you plan on buying a car or a house in the near future, you might want a shorter loan term to get it paid off quickly and improve your debt-to-income ratio for that next big purchase. Choosing the right loan term isn't about finding a single correct answer. It's about finding the answer that's correct for you, and your unique financial situation. By understanding these trade-offs, you can confidently walk into any loan negotiation. Take control of your debt and make a decision that sets you up for financial success. Thanks for watching. I hope this helps you navigate the world of personal loans. If you found this video helpful, please hit that like button. And don't forget to subscribe for more tips on how to master your money. See you in the next one.